Hello and welcome to a new video. Today we will discuss the earning results for the three technology companies Meta, Microsoft and Tesla. For each company we will discuss the current earnings and the future prospects for each company. So let's get straight into it and start with Tesla. Tesla's Q4 2024 earnings, a mixed bag amidst ambitious promises. Tesla's fourth quarter 2024 earnings report painted a complex picture, falling short of analysts' expectations in key areas while simultaneously showcasing growth in its energy business and reiterating ambitious plans for autonomous driving. The results triggered an initial dip in after-hours trading before the stock partially recovered, reflecting investor uncertainty amidst a landscape of challenges and future potential. Financial performance, missing the mark. Tesla's Q4 2024 performance fell short of analyst projections across several key metrics. The company reported adjusted earnings per share of 73 cents, missing the expected 76 cents. Revenue also disappointed, coming in at $25.71 billion compared to the anticipated $27.26 billion. This revenue figure represents a mere 2% increase from the $25.17 billion reported a year earlier, highlighting a significant slowdown in growth. Automotive revenue, a crucial indicator of Tesla's core business health, experienced a substantial 8% decline, dropping to $19.8 billion from $21.56 billion in the same quarter of the previous year. Included within this automotive revenue was $692 million generated from regulatory credits, a factor that can fluctuate and impact overall financial performance. Operating income also suffered, declining 23% year-over-year to $1.6 billion. Net income witnessed a dramatic 71% decrease, falling to $2.32 billion, 66 cents per share, from $7.93 billion, $2.27 per share, the previous year. However, it's important to note that the prior year's net income was significantly inflated by a $5.9 billion one-time non-cash tax benefit, making a direct comparison somewhat misleading. Tesla attributed the revenue and income declines primarily to reduced average selling prices across its entire vehicle lineup, including the Model 3, Model Y, Model S, and Model X. This price reduction strategy, while aimed at boosting sales volume, clearly impacted profitability. The company's operating margin narrowed to 6.2%, down from 8.2% in the same period last year and a significant drop from the 10.8% margin reported in the previous quarter. Deliveries and discounts, a strategy shift. Earlier in January, Tesla announced Q4 2024 deliveries of 495,570 vehicles. For the full year, deliveries reached approximately 1.8 million, marking the company's first annual decline, a significant setback after years of consistent growth. Deliveries serve as a close approximation of sales for Tesla, though the company's definition of this metric isn't strictly aligned with traditional sales reporting. To achieve these delivery numbers, particularly towards the end of 2024, Tesla implemented a strategy of significant discounts on inventory vehicles. Special discounts were also offered to buyers in North America who were referred by existing Tesla customers. In China, Tesla proactively cut prices on its popular Model Y SUVs before launching a refreshed version, the Model Y Juniper, further illustrating the company's focus on price competitiveness. In its shareholder deck, Tesla acknowledged that affordability remains top of mind for customers, signaling a recognition of the changing market dynamics. The company stated its intention to review every aspect of its cost of goods sold per vehicle to further enhance the affordability of its EVs. Focus on the future, autonomy and robotics. Tesla CEO Elon Musk has consistently urged investors to look beyond the current state of the business and focus on the company's long-term vision, particularly in the areas of autonomy and robotics. While Tesla showcased an early prototype of a Cybercab at its We Robot event in October, the company has yet to produce robotaxis. Currently, Tesla offers a premium version of its partially automated driving system, Full Self-Driving, FSD, which remains a supervised system. Meanwhile, competitors like Google's Waymo are making strides in the robotaxi market, with growing commercial offerings in select US cities. Chinese companies like WeRide and Link to Pony.ai are also testing and commercially operating driverless ride-hailing services. Ambitious promises and skepticism. Despite the current challenges, Tesla reiterated its ambitious plans for the future, stating its expectation that the vehicle business will return to growth in 2025. The company reaffirmed its commitment to unlocking an unsupervised FSD option and anticipates beginning to launch its driverless ride-hailing service later this year in parts of the US. During the earnings call, Musk announced that Tesla would be launching unsupervised full self-driving as a paid service in Austin in June. He claimed that Teslas are already operating autonomously at the company's Fremont factory and will soon be doing so at the Texas factory. Musk acknowledged the skepticism surrounding his past predictions regarding self-driving technology, stating, "I'm telling you there's a Wolf this time. And you can drive it. In fact, it can drive you. It's a self-driving Wolf." He added that Tesla plans to release unsupervised FSD in many regions of the US by the end of the year and that there is significant interest from several major car companies in licensing the technology. However, he refrained from naming any specific companies or providing a definitive timeline. External factors and brand image. Tesla's brand image and valuation have been subject to external factors. As reported by CNBC, Tesla's brand value reportedly decreased by $15 billion in 2024, attributed to factors such as the company's aging EV lineup and Musk's controversial political rhetoric and conduct. Musk's recent offensive jokes and gestures, as well as his promotion of a far-right political party in Germany, have drawn criticism and potentially impacted the company's brand perception. Energy business, a bright spot. In contrast to the automotive segment, Tesla's energy business demonstrated strong growth in Q4 2024. The company reported energy generation and storage revenue of $3.06 billion, a substantial 113% increase from the same period the previous year. This performance highlights the potential of Tesla's diversified business model and its commitment to sustainable energy solutions. Conclusion: a balancing act. Tesla's Q4 2024 earnings report presents a mixed bag for investors. While the company faced challenges in its core automotive business, including declining revenue, income, and deliveries, it showed strength in its energy segment and reiterated its ambitious vision for autonomous driving. The company's future success hinges on its ability to overcome these challenges, deliver on its promises regarding autonomous technology, and navigate the increasingly competitive EV landscape. The interplay between its technological prowess, market position, and the controversies surrounding its leadership will continue to shape Tesla's trajectory in the years to come. We will now move on to Meta, but before we do, if you find this information helpful and useful, please consider liking and subscribing. We would really appreciate it. Now, Meta. Meta's Q4 2024 earnings, a story of strong performance and cautious outlook. Meta Platforms, Nasdaq, Meta, delivered a mixed bag of results in its fourth quarter 2024 earnings report. While the social media giant surpassed revenue expectations for the quarter, its revenue guidance for the upcoming quarter fell significantly short of analyst estimates, raising concerns about the company's future growth trajectory. Q4 performance, beating expectations. Meta reported robust fourth quarter revenue of $48.39 billion, exceeding analyst estimates of $47.04 billion. This represents a healthy 20.6% year-over-year increase, demonstrating the continued strength of Meta's advertising business. The company also delivered a strong beat on earnings per share, EPS, with GAAP profit reaching $8.02 per share, significantly higher than the consensus estimate of $6.76. This positive performance reflects Meta's ability to monetize its vast user base and effectively leverage its advertising platform. Q1 guidance, a cause for concern. Despite the strong Q4 results, Meta's revenue guidance for the first quarter of 2025 painted a less optimistic picture. The company projected revenue between $39.5 billion and $41.8 billion, with the midpoint of $40.65 billion falling short of analyst expectations of $41.65 billion. This guidance suggests a potential slowdown in revenue growth and raises questions about the company's ability to maintain its current momentum. Key metrics and highlights. Revenue, $48.39 billion, 20.6% YoY growth. EPS, GAAP, $8.02. Q1 revenue guidance, $40.65 billion. Midpoint, operating margin, 48.3%, up from 40.8% YoY. Free cash flow margin, 27.2%, down from 38.2% QoQ. Daily active people, DAP, 3.35 billion, 5% YoY growth. Market capitalization, $1.70 trillion. Zuckerberg's perspective and AI focus. We continue to make good progress on AI, glasses, and the future of social media, commented Mark Zuckerberg, Meta's founder and CEO, highlighting the company's focus on innovation and future growth areas. Business overview and growth drivers. Meta Platforms operates some of the world's largest social networks, including Facebook, Instagram, WhatsApp, and Messenger, along with its metaverse-focused Reality Labs. The company's revenue is primarily generated through advertising on these platforms. As businesses increasingly shift their marketing budgets online, Meta is well positioned to capitalize on this trend. Meta has demonstrated consistent sales growth over the past 3 years, with a compound annual growth rate of 11.7%. Analysts project continued revenue growth in the coming years, driven by the company's newer products and services. Key growth drivers include increasing user engagement, improved ad targeting capabilities, and expansion into new markets. User growth and monetization. Meta's user base continues to grow, with daily active people reaching 3.35 billion in the latest quarter. The company added 160 million daily active people in Q4, representing a 5% year-over-year increase. While user growth has been strong, it has slowed somewhat in recent years due to the company's already massive scale and market penetration. Average revenue per user, ARPU, is a crucial metric for Meta, as it reflects the company's ability to monetize its user base. Meta's ARPU has seen significant growth in recent years, demonstrating the value of its platform to advertisers. In Q4, ARPU reached $14.44, a 14.9% year-over-year increase, outpacing user growth and indicating improved ad targeting and effectiveness. DeepSeek's impact and AI investments. The recent emergence of DeepSeek, a Chinese AI company, has added a new dimension to the AI landscape. DeepSeek's advanced AI models, reportedly developed at a fraction of the cost of comparable systems from US companies, have raised questions about the efficiency of current AI development strategies. Zuckerberg acknowledged that it is still too early to assess the full impact of DeepSeek's emergence on Meta's investment and capital expenditure strategy, but he noted that Meta's AI teams are already incorporating insights from DeepSeek into their plans. Meta is heavily investing in AI infrastructure, with plans for capital expenditures of up to $65 billion in 2025. This investment is aimed at expanding the company's AI capabilities and supporting its ambitious AI initiatives. Meta aims to end 2025 with over 1.3 million GPUs and bring approximately 1 gigawatt of computing power online. The company is also working on developing its own custom silicon for training AI systems. Reality Labs and Metaverse ambitions. Meta continues to invest heavily in its metaverse-oriented Reality Labs unit, which develops virtual and augmented reality technologies. While Reality Labs beat sales expectations in Q4, it still incurred a significant loss of approximately $5 billion. Zuckerberg believes that the business opportunity for Meta in AI lies beyond 2025, suggesting a long-term vision for the metaverse and AI integration. Cost management and restructuring. To improve efficiency and performance, Meta has implemented cost-cutting measures, including layoffs of 5% of its workforce and plans for further job cuts in the future. These measures are aimed at streamlining operations and freeing up resources for investments in key growth areas like AI and the metaverse. Conclusion: navigating the future. Meta's Q4 2024 earnings report presents a complex picture. While the company delivered strong financial results for the quarter, its cautious outlook for the upcoming quarter and its significant investments in AI and the metaverse have created some uncertainty among investors. Meta's future success will depend on its ability to effectively execute its long-term strategy, navigate the evolving AI landscape, and successfully monetize its user base across its various platforms. The company's ability to balance growth with profitability, while managing the challenges and opportunities presented by emerging technologies, will be crucial for its continued success. Now, let's move on to Microsoft. Microsoft's AI spending spree, a race against demand and emerging competition. Microsoft is aggressively investing in data centers to fuel its cloud computing and artificial intelligence (AI) ambitions. In its most recent quarter, ending December 31st, the tech giant spent a staggering $22.6 billion on capital expenditures, nearly double the amount spent a year prior. This aggressive spending aligns with the company's stated plan to invest approximately $80 billion in data centers during the current fiscal year, which concludes in June. This rapid expansion is driven by a critical capacity shortage, as Microsoft struggles to meet soaring customer demand for its AI and cloud computing services. Despite this significant investment, Microsoft reported solid overall growth in both profits and revenue. Revenue reached $69.6 billion, a 12% increase year over year, while profit rose 10% to $24.1 billion. These results exceeded both Wall Street expectations and Microsoft's own internal forecasts. As AI becomes more efficient and accessible, we will see exponentially more demand, stated Satya Nadella, Microsoft's chief executive, during a call with investors. DeepSeek's disruptive arrival and its impact. The urgency surrounding AI spending among major tech companies intensified this week with the emergence of DeepSeek, a Chinese startup. DeepSeek unveiled an advanced AI system, reportedly developed at a fraction of the power and cost compared to systems built by leading tech firms. This revelation sent ripples through Wall Street, raising questions about the efficiency and cost-effectiveness of current AI development strategies. Microsoft, the first major cloud computing company to report earnings since DeepSeek's announcement, saw its stock dip by approximately 5% in after-hours trading, reflecting investor unease. Azure growth and AI's contribution. Growth in sales of Azure, Microsoft's flagship cloud computing service, slowed to 31%, slightly below Wall Street projections. However, a significant portion of this growth, exceeding one-third, was attributed to AI-related services. Investors are hopeful that Azure's growth will accelerate once Microsoft resolves its capacity constraints later this year. However, company executives cautioned that sufficient capacity may not be available until the summer. Microsoft reported that AI sales have reached an annualized run rate of $13 billion. These sales encompass access to AI systems developed by OpenAI, the creator of ChatGPT, in which Microsoft is the largest investor. The revenue also includes computing power provided to customers who utilize OpenAI products directly. The financial agreement between Microsoft and OpenAI is set to expire in 2030. Diversifying AI partnerships and renegotiating with OpenAI. For over a year, Microsoft has been working to offer customers access to AI systems beyond those developed solely by OpenAI. This strategy was underscored by the recent addition of DeepSeek's AI system to Microsoft's catalog of AI models. Furthermore, last week, when OpenAI announced its $100 billion Stargate project with Oracle and other partners, Microsoft revealed that it had renegotiated its deal with OpenAI. Under the revised agreement, Azure is no longer the exclusive data center provider for OpenAI's development efforts. While Microsoft retains the first right of refusal for infrastructure spending related to OpenAI, it can now decline and allocate its resources elsewhere, especially if capacity is limited. On a day like today, that bet looks like a clever one, noted Karl Kierstead, an analyst at UBS, in a note to investors, referencing the DeepSeek development and its potential impact on the value of Microsoft's investment in OpenAI. While DeepSeek's advancements introduce uncertainty regarding Microsoft's OpenAI investment, they could also potentially reduce capital expenditure requirements for Microsoft and its competitors, which Kierstead described as generally a good thing. Microsoft's finance chief, Amy Hood, informed investors that capital expenditures would continue to rise in the next fiscal year, but at a slower pace than the current year. The New York Times has filed a lawsuit against OpenAI and Microsoft, alleging copyright infringement of news content related to AI systems. Both companies have denied the claims. Other business segments. In other areas of Microsoft's business, sales of its online productivity tools for businesses, including Excel, Teams, and Word, grew by 15%, excluding currency fluctuations. According to analysts at Bank of America, approximately 5% of eligible Microsoft 365 commercial customers have upgraded to include Copilot, Microsoft's AI companion. Microsoft's personal computing business remained relatively flat, generating $14.7 billion in revenue. We would like to thank for watching the video. Please consider liking and subscribing. Thank you for watching, and we will see you in the next one.